Okay, everyone, we're back. We got a brand new setup to introduce today. This one's a really, really cool one. One of the reasons I think this is a cool one is because this setup is something that gets talked about almost every single year. It reveals itself on, let's say, CNBC or Bloomberg. This is something that other people have heard about, but I think one of the really cool things is, again, our data engineers have done a great job digging into the real numbers to figure out the best way to go about this method. So I call this the finishing strong setup, and I'm gonna skip all the pleasantries because you guys don't care about that. Ultimately, you want to know how to make the most amount of money and spend the least amount of time doing it. So let's get right into it. The finishing strong setup. A lot of you will know this as the Santa Claus rally. So here we do. From 1986 to present. So depending on when you're watching this video, that's about 30 years of data, and we're doing it in the S&P 500. So we're testing the returns of the Santa Claus rally, which in our opinion is December 15 to January 3rd. So again, we're doing this over a 30-year period in the S&P 500, and we're just testing purely the returns of the Santa Claus rally, which again is December 15 to January 3rd. So looking at the S&P 500 over that 30-year period, broken down by its seasonal charts, which mean basically we're taking every January 1st over the last 30 years, every January 2nd of the last 30 years, and so and so and so. And what happens is what's kind of highlighted here on the gray on the right side, which again is January 15th to the end of the year, then over on the left side to January 3rd, we see that there's a very big consistent rally over that 30-year period, again, in that Santa Claus rally in the S&P 500, which again is December 15 to January 3rd. And if we break it down specifically by each year, then we see an overwhelming majority of not only victories, but some of them pretty sizable. Obviously in there are times when this doesn't work amazingly, but again, we're going to be investors and we're going to be traders in the market, not for the next year, not for the next 2 years, but for the next few decades. And obviously, if you had done this over the last few decades, you would have been a substantial winner. So if we look at the numbers here, again, S&P 500, Santa Claus rally, which we're calling the finishing strong setup, from December 15 to January 3rd over the last 30 years. We have an 80% win rate. The most we've ever made was about 9%. The most we ever lost is about 1.5%. So this is where it gets very, very interesting. And at the same time, the average return was 2.15%. Not bad for just about 16, 17 days of holding your money. But that wasn't good enough for us. While 2.15% is great, I wanted to figure out if any of the other indexes, like the Qs or the NASDAQ or IWM or Diamonds, I wanted to figure out if any of those were better than SPY. So we dug and we did find a winner. So what we did is now, over the last 20 years, in the DAX, and this is like the S&P for the Germany stock market. There is an ETF for this that trades very, very well in the United States. It's very, very liquid, called EWG. So if you're thinking about what to do in the DAX, you can do something in EWG. And again, we tested the returns of the Santa Claus rally, and the Santa Claus rally in Germany is December 13 to January 2nd. Now, again, the seasonal chart over the last 20 years in the DAX, we can see there's even a greater shift. Right? A greater shift in the S&P, there's a greater shift compared to the S&P 500 in the DAX from, again, December 13 to the end of the year all the way to December 2nd. And if we break it down by individual years, we've seen over that 20-year period, we've only had 2 times when the DAX wasn't up. One of the times it was down almost 5%. The other time it was a break even. All other scenarios, big, big rally. And we break it down into pure numbers, which again, the finishing strong setup, a lot of you know it as the Santa Claus rally. In the DAX specifically, over the last 20 years, from December 13 to January 3rd, we saw a 90% win rate. Our biggest gain was 16%. Our biggest loss is 5%, but the average return, 3.66%, which obviously is about a 50% greater outperformer in terms of average return compared to the S&P 500. So how do we do this? Well, very, very simply. On those dates, so for the S&P 500, if you want to go ahead and do the S&P 500, you can get long December 15 either with futures, stocks, ETFs, or options and holding till the end of the day on January 3rd. Now, if you wanted to go ahead and do the DAX, because the DAX outperformed, let's say, the S&P 500 over that time, you would get long the DAX December 13, whether futures, stocks, ETF, options, and you would hold all the way to the end of the day on January 2nd. Nice and simple setup. You guys are going to get email notifications about this. That's the finishing strong setup. Again, S&P 500 and DAX over a 20, 30-year period are averaging 2%, 3% returns just for holding the stocks a little bit more than 2 weeks. Take note, guys. I'll see you guys in the next video.